board Vinod Karki, the head of strategy at ICICI Securities, to get a better sense on what to make of the markets and where we are headed right now, how the FIIs are positioned right now, or what's it looking like for the markets given the kind of volatility that we've been seeing from Trump's tariffs and a lot more. Mr. Karki, hi, good afternoon, and thanks so much for joining us. First up, I just want to ask you that after the recent leg of correction and the volatility that we've seen in the markets after Trump's tariffs, we've erased all of those tensions, rather you could say, all of those losses from the 3rd of April, and now we're much higher than that point. Do you believe this is a case of too much too soon once again and a leg of correction is ahead of us, or do you believe that this run-up that we've seen is sustainable for a little bit in the future?
Yeah, hi, good afternoon. So I think it is more of a reflection of the road ahead being not clear, basically. Unlike past crises, if you see something like a global financial crisis or the COVID, these were kind of irreversible processes where you had to endure the downtrend big time. Now, in this case, this crisis has exit options in the sense that if tomorrow, the China and US sit on a bilateral trade agreement and try to sort out something, this crisis will kind of diminish to a large extent. Obviously, there will be some impact, but it can go worse also. So I think, especially for India, if you see post September 24, when we made the Nifty made 26,000, which was a high at a very high valuations, the story that was getting traction was that India will lose at the expense of China and US equity markets because their growth was looking much better and valuations, especially in China, was looking much better. Now that has gone for a toss to some extent because the key concerns are the growth in the US, which some people are even talking about recession. And obviously, China will bear the brunt because it is the largest exposure to that country. So, and India, there are, theories being made out that it is possible that India may actually, at the margin, gain some market share in the global export arena. So, so India growth is looking relatively better, and that story that there would be more allocation towards China and US at the expense of Indian equities, I think that is going away. So I think a lot of things are happening, and it is still not pretty clear, but there is no preset trajectory as of now to really, think one way, basically.
Right, Mr. Karki, hi, this is Ankita also joining in. Good afternoon to you. Mr. Karki, I was going through your report, and as I see, the FPIs are, the buying that we see coming in from FPIs now, we're slowly picking up. That's mostly driven by the financial stocks, whereas the mutual funds are more concentrated towards the domestic cyclicals. Tell us, what are the pockets of value that you see within the domestic cyclicals? What would be your preferred sectors?
So, if you have been tracking our reports, I mean, we have been over the last several months saying that the key areas where still there is a reasonable amount of value, despite the market at the headline being expensive, was largely in financials and commodities, basically. And financials, we have seen how large banks and even large NBFCs, outperform and almost, some of them reaching all-time highs. And now we are seeing some bit of at least even the commodities doing well in some pockets, given some protectionism and other things happening. So I think these two areas, which is the financial space and commodities in general, offers value wherever the growth outlook is improving, pricing environment is improving. I think that those are the areas where there was value. Obviously, the growth from a growth perspective, you have to see, we were seeing more growth on the industrial, capital goods, defense, and the discretionary consumption to some extent. These are the pockets where we saw either growth or growth and value together.
And Mr. Karki, I'm just looking at the 2026 Nifty targets that you've given. It's quite the wide range, right? Because the bull case target you've shared is 28,100, bear case is 20,000, base case being 26,000. Given the current scenario, the way the world is shaping up right now in terms of tariffs, you have a lot of other fundamentals at play as well. You also have the earnings season that's in full swing now. By the end of this calendar year, where do you think we're headed in terms of the Nifty target?
So I think, as the report itself is showing, the base case, we believe that while tariffs will be higher, I don't think there'll be complete rollback of these tariff hikes. But I think over the next few months, you should see some bit of bilateral trade agreements being signed, which kind of carve out certain products and certain countries giving some, leniency and those kind of things happening. I don't think it will be an all-out trade tariff war as it was being made out. There will be carve-outs and different trade agreements being signed. So I think, on balance, I think better sense should prevail, and the global leaders should, have the sense to at least ensure that we don't get into a global sharp recession, which takes down every country down, and that's a bear case scenario. So I think better sense will prevail. But having said that, there will be slowdown because I don't think the entire thing will be rolled back. There will be some amount of higher tariffs on certain products in certain countries, but it won't be a dire consequence kind of a situation at the end of it over the next few months.
Right, Mr. Karki, now that we are largely past the tariffs, there could be certain uncertainty, but largely we have priced in. We also have priced in the earnings downgrade. The dollar index has cooled off. There is a chance of further weakness in the dollar index, which augurs very well for emerging markets, especially India. So how should one reallocate their portfolios now? How should one play this market?
So, as I said, from a global risk-reward perspective, I think if things are reasonably fine and India does get a bit of higher global export market share, and that should attract higher FDI into India in setting up manufacturing base, I think, and see, the rupee performance is a big factor for FIIs because that increases their performance in rupee terms. So, and which was not the case last year. If you see, the rupee depreciated, and that was a double whammy for some of the FIIs along with the capital gains impact. So I think that should help a relatively better growth inflation dynamics for India. Even the inflation trajectory is good and relative growth if it does well, and the rupee holds on to its gains. I think you could see more investment into India from a relative perspective for a global investor. For a domestic investor, as I said, I think the demand will be higher on the industrial side, the large financials, some bit of discretionary consumption. And one should not forget that if at all we were to make some market share gain on the global arena, I think some of these manufacturing companies, where we have a manufacturing base and some of these companies are exporting to US and other geographies, should actually see market share gain. That will be seen, as how it progresses.
Okay, Mr. Karki, on that note, we'll let you go. Thanks so much for joining us and sharing your outlook as well as the strategy going ahead on how to play the market right now. But